would say that's the backdrop. Really, the last 2 weeks has been real consciousness of this late summer slowdown. We're revising down GDP. It seems like earnings estimate forecasts maybe have peaked and are rolling a little bit. That's the backdrop. But, as Josh mentioned earlier, cyclical stocks have been weak since July. So it's not the start of that process. Today, it's a noisier market to try and interpret right now just because of the expiration effects and the technical effects. The S&P closed just a few points below its 50-day average. The mega cap stocks really led the way down because they already are big in the index. We see this index rebalance. Small caps the beneficiary. Actually, the average stock did better, and financial and consumer stocks did better than the index today. So it seems like we're at a moment where we're going to test, is this another one of these routine 3-4% pullbacks that we just race higher from? Or is it because of September, because flows have been so heavy into stocks all year, do we have a little more kind of a reflux action as we come back to work next week?
All right. Today is Sunday, September 19th. This is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight, a Sunday night special. And I know some of you have been criticizing and saying, the program is too long, bro. It's too short. I don't like the way you talk. What's up with the FUD and the scare tactics, bro? How about you try to grow up for a little while? Just try it, give it a shot. If it doesn't work out for you, we'll give you a full refund. Anyways, let's not waste any more time and let's talk about the market right away. Here's a tweet from Jim Cramer, and Cramer says, I cannot believe how nasty this market is. The truth is, Jim, the market is up over 100% since the March bottom. The market gains year to date, historically speaking, are outrageous. These kind of gains we usually see in 3 to 4 years time frame. We got all of these gains in less than a year. It is only rational for the market to do a correction right now. Matter of fact, it is extremely dangerous for the market to continue to rally higher and higher and higher without a 5% correction at least once in a while. Every year in the stock market, we're used to this. Every single year, we get a 10% correction. This is normal. This is how the market functions normally. But of course, these hyper bulls, or shall we say market pigs, they expect stocks to go parabolically higher every single day as if this is the new normal, and it will not be interrupted any way, any shape, anytime soon. And at the mere sight of a slim correction, they start to freak out right away. And the truth is, we talked about the technicals a few days ago. The S&P going back to the trend line this time around, we did not see a bounce like we have seen before, indicating that this time around, the pullback will likely not just be a pullback to the trend line, we bounce. And here we go again, all-time highs after all-time highs. The likelihood is this is the beginning of a bigger correction, an overdue correction for the market, and we should be ready for it. But we have a lot of sources for concern and perhaps alarming items that we have to go over. And therefore, we're going to revisit the wall of worry in a second. But let's talk about the market. Our expectations heading into Friday's quad witching was for market makers to practice maximum pain as they did every single time in the last quad witching events that we have gone through. This time around, it was different, and it was extremely surprising even to me, because my expectations were we're going to flush down in the morning, where market makers are going to kill call holders, and then they're going to do the 180 trip back to the highs of the day to kill put options holders. And by the way, I put my money where my mouth is. And I tweeted that I'm buying the 150 Apple calls, expecting a rebound higher, so market makers can flush out put options holders. And a few minutes later, it became evident to me that this time around, it's going to be different. Why? Because I was watching the chart of the VIX like a hawk, and I will show you in the charts analysis what made me convinced that I should abort this trade, and the likelihood is we will see more pain to come in the stock market. Now, heading into this week, I've already expected the pain ahead of time, and I announced in this channel that I'm buying the 150 puts on Apple, and these puts reaped a lot of gains. Oh, and by the way, Tim Apple himself, the CEO of Apple, also dumped stock at the top last month, which is kind of concerning. The timing, that is. But as I've said before, when Apple goes down, the market will go down because Apple has the highest weighting in the market. And here is the difference this time around in the action of the market. We had an ugly closing. We have technical patterns being broken. We have the VIX closing above 20 for the second week in a row. No more kill the VIX Fridays. No more buy the dip. Matter of fact, this week, every single time, it was sell the rip, not buy the dip. And the market maker killed call options holders, but they failed to kill the bears, put options holders. Matter of fact, this time around, bears won, and they left market makers holding the bag because those who bought the Apple 150 puts or any puts on the SPY, the Qs, doesn't matter. The market maker was left holding the bag because they have to buy, when you exercise these options, they have to buy Apple, SPY, Qs, whatever you bought. They have to buy it at the strike price. And now the market closed at the lows of the day. So they're losing money. And this is a significant change in the sentiment of the market. The forces of selling were so strong on Friday that we have to notice that. It's not just quad witching. It's more than that. It is the seasonality. It is the mechanics of the market. And more importantly, the state of the economy and the upcoming tapering. And that leads us to the discussion regarding the economy. And we start with the wall of worry. This is the previous wall of worry, by the way. For the month of August, we had Afghanistan, China, the virus, and tapering. Now, when it comes to Afghanistan, it's not a concern anymore unless Americans die for whatever reason. Oh, wait a minute. Americans actually died. Marines were killed. And what was the response from Uncle Joe? Yep, he killed innocent civilians. He showed them, right? He's gonna hunt them down. He killed 7 kids, including this one. Take a look at it, Joe. This is who you killed, trying to be a tough guy. After you up the debacle of the century. And there are more debacles to come from the Biden administration, aka the BlackRock administration, aka the Yale administration. See, we don't have Democrats and Republicans. We have the BlackRock administration, and we have the Goldman Sachs administration. We have the Yale administration, and then we have the Harvard administration. And of course, the CIA warned about the civilians on the path of the strike. But Uncle Joe says, come on, man, that was 4 minutes ago. But here is the new wall of worry. We're not going to worry about Afghanistan anymore, but we have more items here. We have the Biden administration. We have the debt ceiling and the debt crisis that is about to happen. And we have margin calls. And by the way, the topping of margin in the market, which is a solid signal of a market top. We'll talk. But let's start with China. Is China still a source of worry that we have to pay attention to? Of course. Look at what's going on with the crackdowns every single day. Every single day, we get news in the morning that China is cracking down on something. And the latest casualty is the casino industry. Of course, we've all witnessed the price action in names like Las Vegas Sands and Wynn Resorts. Massive devastation here. And who knows what the next shoe to drop will be. My guess is the Chinese government will crack down against American companies, and that will be the end of the market right then and right there. The market will not be able to handle the Chinese Communist Party cracking down against American companies' presence in China. Whether we're talking about Starbucks, Nike, Apple, it doesn't matter. If these names get hit, it's over. The market will suffer pain like you have never seen before. Now, let's talk about Delta and what's going on with the virus. We have more debacles here. Biden came out announcing the booster, that we need a 3rd shot booster. What do you know? On Friday, the FDA says we don't need a booster. The booster is going to be only for the elderly and those who are immunocompromised. So once again, flip-flopping, information all over the place, confusion all over the place, and now even the vaccinated, by the way, are getting frustrated. What's going on here? Can somebody please tell us the truth about what's going on here? Because how long do we have to stay in this misery? How long do small businesses in this country have to suffer? We have an eviction moratorium that expired. People are getting evicted. There's a lot of pain all over the place. And there is no end in sight when it comes to this virus, which is, by the way, at this point, we have to come and face the reality. This is not a product of nature. This is a product of human engineering. And now we're getting the news that the Chinese lab created a coronavirus 10,000 times stronger than the usual. And we're getting more concerns that perhaps this one that we have right now was actually leaked out of the Wuhan lab. And more debacles. We're getting more evidence that the NIH actually funded the lab and the gain of function research. So what's going on here? Can somebody please enlighten us with the truth and stop playing around the facts and beating around the bush? Because the market has a certain level of tolerance where bad news is good news. Why? Because bad news prompt the monetary policy to become more generous, aka more printing and more liquidity for Wall Street and the stock market. But there is an inflection point where we have inflation rising out of control, prompting the Fed to taper. On top of that, the bad news are becoming worse. And there is a tolerance level here where the market is going to break. Say, you know what? We cannot handle this anymore. If this crisis with the virus continues and prolongs, perhaps we're going to get the worst of it in this upcoming fall winter season. Who knows what variant is going to be unleashed on us in the fourth quarter? And will the vaccines hold? Will they not hold? Will we need boosters? No boosters, we have no clarity at all, and the market hates the lack of clarity. What else? We have tapering, we were just talking about that, and guess what? On Friday, we got the Consumer Sentiment Index, and we have the worst buying conditions since 1980. The consumers are saying prices are going out of whack. What's going on here? We cannot continue to keep up with the pace of prices rising higher and higher and higher. The Fed continues to say that this is transitory. But what is transitory? We are already in September, Mr. Powell. And now the Fed is stuck between a rock and a hard place. On one hand, you have inflation rising out of control, out of whack. On the other hand, the recovery in the employment picture is not happening as rapidly as the Fed expected. And the Fed is getting more evidence right now that their cocaine operation of quantitative easing only helps in propping up stocks in the real estate markets, but have little impact in recovering employment in the economy. On top of that, if the Fed does taper, there is the risk that perhaps we will have a stronger variant in the future, and the crisis when it comes to the virus will deepen, and we will need more generosity from the Fed. This path we're on right now is a path of uncertainty, and the market does not like uncertainty. When there is uncertainty, combined with the seasonality, combined with the other factors of tapering and top sentiment, boy, this is a recipe for disaster here. Now, what about the Biden administration? We're getting bad news after bad news after bad news. The Biden administration has been on a streak of bad news and debacles all over the place. And now we have France recalling the ambassador from Washington without delay as Macron rages at Biden. And this is, of course, in relation to the submarine deal with Australia, where we usurped the French. And what's going to happen from this crisis now? Are we going to have a tariff war? Who knows? We know that the French are holding the weaker card here. What are they going to do? Break up ties with their biggest ally? That's not going to happen. So the French are going to throw a fit here, bitch and whine for a little bit, but they're not going to do anything. However, the risk is what happens if we have a new tariff war where the French decide to retaliate, and here we go again, we have an inflation crisis. On top of that, we're going to have a trade war with France, one of the top allies of the United States.
Oh, Jean-Philippe. You're home. I called you 5 times. Qu'est-ce que c'est? Message machine broken. You fucking avoiding me, motherfucker?
And remember when CNN used to say that Trump is embarrassing us with our allies, etc., etc.? What is CNN saying right now regarding this debacle from the Biden administration? And the worst of it, by the way, is all of these debacles are making the orange clown look pretty good. And now our choices are going to be between Biden and the orange clown. This country is beyond doomed, folks. If these are our choices, Alzheimer Joe and the orange clown, we're doomed. Not just economically, by the way. Next, we have the debt crisis, the looming debt crisis. Of course, we had these episodes before, the politicians participate in a circus, going back and forth with the threats of a shutdown, etc., etc. And of course, as we head to the deadline, they come up with a deal, a last-minute deal, because a government shutdown means that they're not going to get paid your beloved politicians, they're not going to get paid to go on vacations. And therefore, the assumption is they're going to come up with a deal. But this time it is different. Why? Because the disagreement is we have a multi-trillion dollars infrastructure deal. Now, the country indeed in dire need for infrastructure spending, perhaps trillions of dollars, because we're falling behind China and other nations. And the infrastructure in this country is aging and decaying. We have not had a legitimate national program of infrastructure since the 1950s. The problem is who's going to pay for it, because the national debt is already at the moon, beyond the moon at this point. I wish we had call options on the U.S. public debt. So where will the money come from? Well, we know that the Fed has expanded their balance sheet beyond any rationale, trillions and trillions of dollars. And the question is, where did all of these trillions and trillions go if they did not go for infrastructure spending, etc., etc.? The answer is the trillions of dollars went to the pockets of Wall Street and the 1%, creating a massive bubble in the equities and real estate markets. And oh, by the way, the market will not be able to hold. Both the equities and real estate markets will crash, meaning that all of these trillions and trillions and trillions of dollars, poof, gone. They got flushed down the toilet. And who's going to pay for the infrastructure bill? The answer is you and I. Taxes are going to go higher across the board, from the rich, middle class, poor, capital gains. It doesn't matter if you're a millionaire or you're just a day trader, capital gains taxes will go higher because somebody gotta pay for all of this. We have multi-trillion dollars in budget deficit. Who's gonna cover that? What I'm trying to say is, this time around, it is different when it comes to the debt crisis. And we could see a government shutdown. We have warnings of economic catastrophe come as Congress prepares to debate debt ceiling. Remember that Janet Yellen, the Treasury Secretary, said that they will use extraordinary measures until October. But we're running out of time, and the extraordinary measures have already been exhausted. And by the way, Yellen says that Biden's budget will expand the debt. Yes, we admit that, but it will not stoke higher inflation. Lady, we already have inflation right now raging out of control. What are you talking about? Absolute delusion. Oh, and by the way, after all of these trillions and trillions and trillions of dollars that the Fed added to their balance sheet, now we have the heart of the economy, small businesses suffering, and they're asking for more aid. We need another round of stimulus to bail out small businesses. But the main question is, where did all of these trillions and trillions of dollars that the Fed printed go? Did the trillions go to help small businesses, average folks, build infrastructure? Of course not. Trillions and trillions of dollars went into propping up the equities and real estate markets and buying Apple bonds. The Fed just hammered the nail on the coffin of the economic future of this country. The rich, they won. Their equity values went higher to the stratosphere. They took advantage. They dumped stock, making billions and billions and billions of dollars. The fake money becomes real money, and they use that real money now to buy real assets. They're buying single-family homes across the country. They're buying lands, millions and millions of acres of land across the country. They're buying farms across the country. Why? It's an interesting question, isn't it? Now, let's talk about margin, because we have the media, the Fed, and all of these experts, quote unquote, say that this crisis is different. It's not going to be a crisis to begin with, because back in 2007 and other years, we had reckless kind of spending and reckless borrowing when it comes to debt and margin and all of that. Let's look at the facts here. The headline reads, investors are borrowing less to buy stocks, and that could be a bad sign. Why is that? Falling margin debt may be a signal that investors are growing cautious about the market. Indeed, as Stephen Whatever says, technical research strategist at Bank of America, wrote in a Monday note, rising leverage tends to confirm U.S. equity rallies. It is not new record highs for margin debt that we worry about. Instead, we get concerned when margin debt stops rising. This suggests that investors have begun to reduce leverage. He points out that the S&P 500 rose 2.3% in July, but margin debt dropped by 4.3% from its high the month prior. Now, what does that mean? Yes, margin borrowing is a normal part of the market. Sometimes it gets reckless, as we've seen with the Archegos disaster, when we have Bill Wong taking margin like crazy. gambling on stocks. Then he gets caught, and who ends up holding the bag? Credit Suisse and retail investors who chased the rally higher in Viacom and Discovery. This is one risk, but perhaps there is another side when margin debt tops. Why? Because historically speaking, a topping in margin is a sign of a market top. It is a leading indicator for a market top, because the sentiment changes from being extremely bullish, taking margin, having high conviction that the market will continue to go higher and higher and higher, and therefore maximizing gains via margin. But when the institutionals, the big guys, start to reduce their margin exposure, this is a sign that they no longer have conviction that the market will continue to go higher and higher and higher, and thus de-risking before the crash. The problem is, while the institutional investor is decreasing their exposure to margin, retail investors continue to expose themselves to more and more margin. Here is the chart of margin debt in the S&P 500, and as you can see, every time margin debt topped, it was a leading indicator of a market crash. And right now, margin debt has topped back in June. What does that mean? It means that we have a market top imminent. Here's another way to illustrate that. If we invert the margin debt, as you can see, every time margin debt bottoms, because this is an inverted chart, perhaps it illustrates the correlation a lot more clearly. Every time margin debt bottoms in this chart, we see the S&P 500 topping. And by the way, here is the risk. What happens if we have a tsunami of margin calls as the market starts to trade downward? We have the highest negative balance exposure among investors ever in the history of the stock market. What does that mean? This one will be historic. If the market falls apart, it's not only going to cause an economic crisis, but a political crisis, because who will get the blame, by the way? Once again, the Biden administration. Now, on top of that, we have one of the highest valuations in stock market history. When we talk about the price to sales ratio, we have the highest ratio in history. When it comes to PE ratio, for example, the current deviation from the arithmetic mean is over 120%. This is the most overvalued market since the dot-com bubble. Here's another way to illustrate that. The valuations that we have right now are richer than the 1929 peak, the 2007 peak, and it's only second to the tech bubble of the 1990s. And we all know how that bubble ended. The difference back then, the bubble was limited. The crash was limited to the dot-com names, the high-tech, high-momentum names. The cyclical stocks of the market were not touched at all by the crash of 2000. Oh, and one more thing, the Fed back then had a lot of room to accommodate the market if there was any weakness. This time around, the overvaluation is not limited to the tech and high momentum, but across the market. The entire market is overvalued. In addition, the Fed has less room for maneuver, has less room for accommodative policy. It's already accommodative to the max, and therefore this upcoming disaster will be much worse than the end of the tech bubble in 2000. Jim Cramer says he cannot believe how nasty the market is right now. Cramer, you might want to wait here because you haven't seen anything yet. And with that lovely positive note, let's move on to the charts analysis, shall we? Starting with a 30-minute chart for the SPY, the S&P 500. Now, in Thursday's video, I discussed the triple top, but also the false reverse head and shoulder formation. I said that perhaps market makers in the shakedown operation, in moving the market down to shake out call holders and then moving it back up to shake out put holders, they have created a false pattern of a reverse head and shoulder. Therefore, it is unreliable. What do you know? On Friday, the market opening gapping down, and it continues to flush down all the way till the end of the day. Even I, the king of bears, have anticipated that the market will do a 180 to shake out put options holders, and it will be parked flat, pretty much. The maximum pain theory. This didn't happen. The market continued to flush down all the way till the end of the day. There was an attempt midday to cross above 443, which is the resistance right now. That attempt was met with failure. That was warning signal number one, that the market is struggling to find momentum to rally higher. Where do we go from here? A lot of weakness. We have what we call oversold conditions on the RSI, perhaps prompting a bounce, but so far every bounce we got in the market was sold. Sell the rip. We're moving from buy the dip to sell the rip. So any bounce right now in the market will be met with skepticism, not just due to sell the rip, but also due to the seasonality. September 17th and beyond is the worst season for the stock market, all the way till November. I wouldn't be comfortable to call this correction over until and unless the SPY reclaims 447 for support and confirms that support. Other than that, we're going down. We're going down to the support of 438, perhaps. 438 is more reliable and a solid point for a rebound. What do we see here in the daily chart for the continuous contract on the SPY? The momentum remains weak, negative divergence on both the RSI and the MACD indicators, and we have a break of the trend. We've already talked about this revisit back to the trend line as being a little different. In the past 3 revisits, the market rebounded quickly and strongly, massive green candles. This time around, we did not have that. The market continued to grind and hold and hold and hold to the trend line, and it finally gave up on Friday. Usually, not always, but usually, this is a sign that there is more pain to come. Point number 1 for support is 4,384.5. If that is broken, then we will see significant pain to come because the next stop will be 4,232. What about the NASDAQ 30 minutes chart? Again, we have the triple top at 378.45 or 0.50. You can round it up, it doesn't matter. There is no specific exact number. Every algorithmic program has its own number in or around the same zone. But what happens after triple rejections? You have a flush down. We did not go all the way down to the support of 372, but the weakness in Apple is extremely concerning. And if the big cap technology names fall down, then the NASDAQ have a lot more pain to come. Again, we're not going to be comfortable to go along the market again until the Qs passes 378.45, closes above that level, and reconfirm it for support. Other than that, we have more pain to come. What about the daily chart for the continuous contract on the Qs, the NASDAQ? Believe it or not, the candlestick pattern remains bullish. We have a bull flag consolidation, but the candlestick patterns are not reliable on their own. You have to combine them with all other indicators, technical and otherwise. We have the MACD and the RSI indicators trending negative, with negative divergences in both. Likewise, the volume is rising higher on down days. A matter of fact, this is the highest volume we have seen in the NASDAQ since August on a down day. What does that mean? Perhaps we have more pain to come. I'm looking at 15,000 as the point for the rebound. If that doesn't hold, oh boy, we have a lot of pain to come. What does that mean? Let me illustrate for you by visiting the NDX chart, the daily chart. We have a trend line that goes back all the way since last year, and we have seen some nasty corrections here. Last September, we have seen about 15% correction from the top, followed by another 10.5% correction from the top, and another 12% correction. And most recently, back in May, we have seen a correction of about 8% from the top. Since then, we have not seen any correction or any revisit back to the trend line, which is extremely alarming. If this is the top for now, and the NASDAQ is going down to retouch the trend line, then we have a correction of about 8.5%, 9%, let's say 10%, all the way down to the trend line. So this is just the beginning stages of the correction. And again, folks, is a 10% correction the end of the market? Let's panic. Let's say the market is nasty. Of course not. 10% corrections are nothing, specifically when you're going back to the trend line. Now, if the NASDAQ breaks the trend line and shows more weakness, then we're going to start talking about doom and gloom. We have doom and gloom in the fundamentals, but we have not yet to have doom and gloom in the technicals. What about the IWM 30 minutes chart for the Russell 2000? Believe it or not, the Russell 2000 closed in the green on Friday. So while we have seen pain in the SPY, the NASDAQ, the IWM went back home unscathed at all. No problem in the IWM at all. Trading within range, the support at 218, the resistance at 223. Now, the IWM is usually an indicator regarding the cyclical side of the economy, meaning the IWM rises higher when we have more optimism regarding the economy, while it goes down when we have pessimism regarding the economy and the future prospects of growth. So for now, the Russell 2000 is saying no problem here at all. This is just a mere correction, which is normal behavior in the market, by the way, and then we're going to move higher once again. But remember, the technicals say one side of the story. The fundamentals say the other. And the fundamentals are becoming extremely bad here, with the prospects of tapering, etc., etc. Speaking of tapering, what about the Dixie, the dollar index? Popping higher, closing above 93 by a lot. And the momentum indicators, the RSI, the MACD, all curling upward, with plenty of room to go higher. So the dollar could have an insane rally from here. Based on what? Number one, you have the prospects of tapering. When we get the worst buying conditions on Friday, when we have the Empire State Index, the Philly Manufacturing Index, all pointing out to higher inflation, higher prices, supply chain issues, when you have the CPI barely touched by Delta, when we have the weekly unemployment claims coming out at pandemic lows, more calls, more scrutiny on the Fed will take place that you have to taper now. On top of that, by the way, the Fed is laced in scandals right now. We caught Fed presidents from the top dog, Jerome Powell, to Dallas Fed Kaplan, to Barkin, to Rosengren, and who knows who else, been trading stocks and bonds as the Fed continues to grease up the stock and bond markets with trillions and trillions and trillions of dollars. This is the classic definition of insider trading. On top of that, we have an inflation crisis. So perhaps the Fed will distract from its own controversies by tapering and shifting the conversation from the insider trading scandal in the Fed to tapering. And remember, as the US dollar goes higher, you're going to see a lot of pain in commodities and stocks related to commodities. So you have to hedge accordingly. Every time you see the US dollar about to pop, you gotta buy some puts if you have any of these cyclical trades related to commodities. Of course, until the tapering actually happens, and then we have buy the rumor, sell the news in the US dollar. What about gold? What's going on here with gold? A lot of pain, not looking good here, trying to hang on at the support of the Fibonacci level, but it's not going to happen. We're talking about 1,750. The likelihood is we have an upcoming Fed meeting this week. All eyes will be on the Fed meeting. And if the Fed announces tapering, they're not going to taper right now, but they will announce it, perhaps October or November. Or perhaps they will not announce it. Either way, the dollar and yields will move one way or the other, and this will impact gold, commodities, the stock market, and everything else. The leading indicators are the dollar and yields. Let's say the Fed, with all the pressure surrounding it, says we're going to start tapering by the end of the year, perhaps November or even the beginning of 2022. When the market has certainty regarding tapering, we will see the market moving one way or the other. And if the dollar pops due to that reaction, at least for that particular day, you will see a lot of pain in gold, going back all the way to the next Fibonacci support of 1,685. Another thing I want to discuss is the fallacy of gold being a hedge against inflation. This hasn't worked out since the 1970s. Matter of fact, gold, so far going back all the way to 2009, since the cocaine operation started, the quantitative easing, gold has been in an inverse relationship with yields. It used to be back in the 70s when yields went higher, the value of gold also risen higher. This time around, every time yields pop, gold goes down. Why? Because gold has two enemies, the dollar and yields. There was a period around 2014 all the way to 2018 when the dollar moved accordingly with yields. As yields went down, the dollar went down. Why? Because we have seen the massive surge in the US dollar, enemy number one for gold. But again, the evidence is clear. As yields go down, gold goes higher. And as yields go higher, perhaps in reaction to inflation and tapering, gold goes down. Until and unless this inverse correlation is reverted, gold is not a hedge against inflation. Moving on to the 10-year yield, the second enemy of gold, and let's see what's going on here. Popping higher on Friday, not by a lot, still within consolidation range. We know for now that 1.28% is a solid floor for now. The likelihood is, as we get closer to tapering, yields will pop higher. So is it a reasonable bet to go long the TBT proxy for yields as investors the likes of Michael Burry are doing? Yes, it is. But understand, this is not going to be easy because, yes, the Fed might taper and reduce their purchasing programs of bonds by, say, 10 billion, 20 billion a month. But what if we have a shakedown in the global economy, global markets, and that 10 to 20 billion dollars is replaced by foreign buyers buying bonds? Then you're not going to see a massive movement in yields or the TLT, by the way. And here's the chart for the TLT, the weekly chart. Again, still hugging 149, no conclusion at all. We're waiting and waiting and waiting to see the resolution of the battle in the bond market. What about the VIX 4 hours chart? And again, every time we have seen a pop in the MACD indicator from a 4 hours perspective, the VIX rallied double digits minimum. And that came hand in hand with a pullback in the SPY. On Friday, the VIX started to pop higher, and the MACD started to show green columns, and the histogram indicating a successful crossing, a positive crossing in the MACD. This was alarming right away, and I tweeted about it that perhaps we will see more pain here, and we're not going to see the rebound that market makers intended to do to shake out put options holders. Now, is the pop over? It doesn't look like it. It looks as if the pop just started in the VIX. And if that is the case, then we will see significant pain to come in the SPY, the S&P 500. Now, when we zoom in, say the 5 minutes chart on the VIX, Friday's action, and this is, by the way, typical shorting behavior. When you have a significant level of resistance, let's say 20, the chart peaks its head above the resistance level, and that is the first attempt. It goes down to gather more energy. If that energy is not found, meaning new buyers pushing the chart higher, then the chart goes down to the next support level, asking anybody wants to hop on the ride. If not, the chart goes down to the next support level, and so on and so on. But usually, the chart peaks its head above the resistance line. This is the first attempt. It goes down to gather some energy. The energy is found, and the chart rallies aggressively, breaking the resistance level once and for all. And this is a solid bullish signal on any chart when you have the second attempt breaking higher, impulsively higher. And therefore, I'm not sure that the pop in the VIX is over. And if that is the case, then the pain in the SPY is not over too. But for me, the second break that came around 10 Pacific time, 10 o'clock Pacific time. For me, that pop higher convinced me that the market will not do a 180, rallying higher, bouncing higher, buy the dip, not going to happen. And therefore, I abandoned my Apple calls, the 150. I had the 150 puts. I bought them weeks ahead, and I closed them on Thursday because they had 1 day for expiration, and this is the responsible thing to do. But I was betting for a rebound in Apple, aka the market, by the way. It did not happen, and the confirmation for me was the second break on the VIX. And here it is, by the way, the 30 minutes chart for Apple. We discussed 2 scenarios. One of them was bullish, the higher high, indicating that perhaps Apple will visit 150 and will take it from there. And I was leaning to that scenario, by the way. I was leaning toward that scenario. But there was another scenario, a bearish one, of a bear flag pattern. And the bear flag played out, and now we have a pullback, significant one. How far can this correction go for Apple? To answer that question, we have to go and revisit the weekly chart and see where we are right now. We have a trading channel with defined peaks and valleys. We have reached the peak. The chart topped right there. And by the way, Tim Apple of the IMOB, the Capo di Capi, dumped a lot of stock, hundreds of millions of dollars worth of stock, right at the top. So good timing by Tim Apple. And we have the weekly MACD indicator curling down. Perhaps we're about to see a negative crossing. Likewise, the RSI indicator also with negative divergence, topping, curling down. And if we go down all the way till the end of the channel, as we should, the correction top to bottom in Apple should be around 15%. Again, is this the end of the world? Of course not. The risk is if Apple goes down and we have a massive flush down in the market, what happens if margin calls start to hit? This is the risk. Absent of the risk of margin calls, this is just a garden variety correction. But if margin calls hit, then you will see Apple breaching the channel, and we will see a lot of pain to come, not just in Apple, but in the market entirely. What about Tesla, the souffle? Bucking the trend, believe it or not, Tesla was one of those names closing the week in the green. So once again, when we talk about the top names of the market, Apple is down. Perhaps Facebook is getting shot right now. Google will get shot because Google has the same problems with Apple. I'm waiting for Microsoft and Tesla to get shot. We have some catalysts here, positive ones for Tesla, the likes of EV credits, but that's a double-edged sword, by the way, because if you're going to give EV credits to the tune of $12,000 for purchasing an EV, you're not just going to support Tesla, but you're going to support the competition from General Motors, Ford, Toyota, VW, and others. And therefore, Tesla is not thrilled about the extension of EV credits. Tesla is sure that their customers can afford buying the vehicles. They want to buy the vehicles anyways. They're not buying them due to the EV credits. But giving such generous EV credits will impact the souffle negatively because it will enhance the competition. What about the technicals here? We have broken the trend of higher highs and higher lows. The expectations are the chart should consolidate for a little while before deciding where to go next, And this chart, by the way, is a battlefield between bulls and bears. And the weapons of the war this time around are options. When we look at the options grid for Tesla, usually it is split 50-50 between bulls and bears, buying calls and buying puts. And this conflict will be resolved soon. My assumption is if the market crashes, if the market falls apart, Tesla will be one of those last names to fall, not the first. This is how bubbles usually work. For example, in 2000, the names leading the mania, the big ones, Microsoft, Cisco, etc., these were the last to fall. The first one to fall were the high multiple, high momentum names, the .com names. Likewise, in the unwinding of this mania, we are seeing the high multiple, high growth names getting shot first. When you look at charts like Lucid Motor, for example, or Plug Power, or even Palantir, which was a huge outperformer this week, but all in all, down significantly from the top. If these names are shot, what's next? Perhaps these cyclical names already got shot in June, July. Next, we're going to have the big cap technology names and the leaders of this mania higher, including Tesla, by the way. Now, let's revisit the daily chart for the souffle and see where the next resistance is if the chart decides to climb higher. We have 781. This will be my target for the resistance, but remember, the weekly chart of Tesla remains positive because we have positive momentum. You gotta watch the MACD indicator on the weekly chart. If it starts to curl down and you see those green columns getting shorter and shorter and shorter, and we're getting closer to creating red columns on the histogram of the MACD from a weekly chart perspective, then you'll know that we're closer and closer for Tesla to fall apart. Moving on to tulips, BTC, what's going on here? We have a lot of bad news for the tulip market, but the charts are doing fine for now. We're waiting and waiting and waiting for the resolution, one way or the other. We have a bull flag within a bear flag, and this is the nature of the conflict in the tulip market. I think that the technicals will not matter anymore going forward, at least for now. What will matter in the tulip market is the fundamentals, specifically when it comes to regulations. We have a lot of bad news here. The Chinese are already cracking down against cryptos. We have the US government coordinating with the SEC, and we are getting reports that the crackdown against cryptos is getting imminent. Watch out here. What about AMC? What's going on here? Are we going to form the reverse ABC pattern all the way to 42.5? It could happen. For now, the chart is catching support at around 44, which was the previous support, also coincides with the previous gap. The likelihood is 44 will not hold, and the interesting development this time around was the performance of AMC and meme stocks in general. I've told you about the pattern so far. When the market goes down, when we see weakness in the market, usually that leads meme stocks, led by AMC, to rise higher. On Friday, we have seen a different picture. The market was down along with AMC. Remember what I told you. For this market to crash, you need to crash the sentiment. You cannot have pullbacks in the market while meme stocks and cryptos are rallying. You need to see meme stocks and cryptos getting shot along with the market to confirm any market top and any market crash to come. So this development in the performance of AMC on Friday is extremely alarming. And when we look at the weekly chart, it gets even uglier. Look at where the MACD indicator is. It has already topped, and now it is failing to cross once again. It is actually curling downward, as if we have a rejection that the crossing will not happen and we will see more pain to come in the name. Not looking good here, folks. It is becoming extremely dangerous for AMC holders. I know the apes are stubborn, but maybe it is time to book some profits, at least, because this is not looking good at all. And here are some bonus charts. I tweeted that we are looking for a bounce in the casino names, specifically Wynn and Las Vegas Sands on Friday. Now, one of them managed to bounce, which is Las Vegas Sands, but Wynn failed to bounce on Friday. We have significant weakness here in Wynn, and when I look at the weekly chart, we could see more pain to come in Wynn, perhaps going back all the way to the lows of the pandemic crash. And this is a weekly chart, by the way. There is a reason why Las Vegas Sands bounced on Friday while Wynn Resorts failed. And the reason is, due to this news, we have Wynn borrowing about $1.5 billion from the Bank of China. Now pay attention here. This company, Wynn Resorts, is becoming a zombie company, drowned with debt. And the likelihood is it will go bankrupt. and it will be absorbed by a larger player in the casino industry. On top of that, monetary tightening and raising interest rates will be destructive to zombie companies like Wynn. Now, make no mistake, this is a sad development, not just for Wynn Resorts, but for the Las Vegas community. I used to work in the casino industry in Las Vegas, and I have met Mr. Wynn, Steve Wynn, many times, and we've known him as a visionary leader. Perhaps the founding father of modern Las Vegas. So it is sad if Wynn Resorts go bankrupt. Of course, Mr. Wynn got involved in other scandals, and the company went downhill from that point on. But all in all, this is a sad day, not just for Wynn Resorts, but for the Las Vegas community as a whole. We don't want to see this company go down. But here's the other one, Las Vegas Sands. Not doing hot so either. Falling back to the lows, yes, bouncing on Friday, but who knows if this is the end of the pain or not. If the Chinese continue to crack down, we will see more pain to come in Las Vegas Sands. But I do like the chart of LVS better than Wynn. Here's another chart for the ticker GDRX for a company called GoodRx. And I presented this name a few weeks ago as a short squeeze opportunity. I own the stock, and perhaps we have some hedgies watching the show. I know for sure that certain hedgies are watching the show. So perhaps they noticed that I've been talking over and over and over again about the short float in GDRX, and they're starting to cover, because last time around the short float was around 33%. Now the short float is down to 26%. So we know that we have shorts covering here aggressively, which leading the stock to rally impulsively. Now, the technicals look extremely extended. On top of that, we have executives of GDRX dumping, insider selling, taking advantage of the pop higher. So this will be a good point for profit taking, yet I continue to believe that we have more gains in this name because the short float remains highly elevated, so absent of a wholesome market crash, the shorts will not be rewarded in this name. Lastly, what about the performances of different sectors of the market since the March bottom of 2020? Leading the market, my favorite sector of the market, materials, represented by the XME, the materials ETF, outperforming the rest of the market by far. Number 2 is the SMH, chips. Number 3, the XLK, technology. And then we have the rest, energy, financials, etc. Now, in the past, I have talked positively about the materials sector of the market. Understand this, if you buy materials now, perhaps you're buying at the top, and you ought to be careful because the bulk of the rally already happened, and you might have missed the majority of the gains. On top of that, if the dollar rises higher, for whatever reason, perhaps tapering, we will see a lot of pain in materials, commodities, and the XME in specific. So perhaps you want to wait till the tapering outcome is certain and then hop on the ride and decide whether materials are a good investment for you or not. We know we have an infrastructure bill, but who knows what will happen with all of this debt talk, the debt ceiling. The likelihood is they will agree on a lesser spending bill, meaning the $3.5 trillion in infrastructure will become $1 trillion or $1.5 trillion. Anyhow, the tailwinds for material stocks to rise higher are still intact. And by the way, the majority of pain in materials is coming out of gold and silver, illustrated by this chart right here. In red, the XME, in blue, the XLB, both representing materials. The difference is the XLB has a higher weighting for gold and silver, while the XME has higher weighting for steel, copper, etc. And the exposure for gold and silver is limited in the XME. And as you can see, the XME has been outperforming the XLB significantly since the March bottom of last year. Anyhow, folks, we're moving on to the conclusion of this video. What do we have in the economic outlook for this upcoming week? On Monday, we have the National Association of Home Builders Index, and this will be important regarding the housing market. Likewise, on Tuesday, September 21st, we have more data regarding the housing market from building permits and housing starts. What about Wednesday, September 22nd? We have the big day, the most important day, the FOMC meeting, the FOMC statement, and of course the follow-up, the news conference by Chairman Jerome Powell. All eyes will be on Powell and what he will say regarding tapering. And on Thursday, September 23rd, we have, per usual, the weekly jobless claims. On top of that, we have the manufacturing and services PMIs coming out. And lastly, on Friday, September 24th, we have more data regarding the housing market from new home sales. Anyhow, folks, I hope you had a great weekend and you are well rested and ready for the action to come. This is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.